Tulsa County, Tuesday, May the 25th at 10:30. Need motion to approve the minutes, the regular meeting of April the 27th, please.
So moved.
Second. Baker,
Yes.
Fothergill,
Yes.
Little. Yes. Lord. Yes. Saleed.
Yes.
Willis.
Yes.
Hurd.
Yes.
Kaiser. Yes. Is there any unfinished business? We will now have the treasurer's report ending April the 30th from Rachel Johnson.
Thank you. Okay, for April, the transfer to the DDA to cover payables was 2.1 million. I also did a cash draw of 2.2 million, and that was 1.1 million each from Barrow Hanley Fixed and Siegel Bryant. And then the snapshot for the month is a net investment income of 7.2 million. That means year to date up right under 64 million, and total value $340,980,487. And I'm happy to take any questions.
Thank you, Rachel. Thank you. Have a motion to accept and file the treasurer's report.
Move to accept and file.
Second. Baker,
Yes.
Fothergill,
Yes.
Little. Yes. Lord. Yes. Saleed.
Yes.
Willis.
Yes.
Hurd.
Yes.
Kaiser. Yes. Investment managers, accept and file 1 through 8.
To accept and file.
Second. Baker,
Yes.
Fothergill,
Yes.
Little. Yes. Lord. Yes. Saleed. Willis.
Yes.
Hurd.
Yes.
Kaiser. Yes. Now have Doug.
Good morning, Madam Chairperson, trustees. And you see that we have in front of us on the screen the 331 report. We have two reports to go through today, the more lengthy March 31st first quarter review, and then the April 30th review, the monthly flash report. But as Rachel just said and stole the thunder again, the portfolio is up tremendously over the trailing year. If you look at this figure right now, this is the trailing one-year return as of March 31st of this year. And as we sit here in late May, it's been up even further from there, but the returns get a little bit odd when you take off great months at the end from the trailing 1 year. You add on more modest returns here. But this is a great result, 35.6% return. I believe it's the highest one-year return that we've seen at least since the early 2000s, like 2008, 2009 period. But how do we get here? We have to usually endure a dramatic down market. So as we go through this report, can we get to the market environment, which is on page, I'm flipping through here on pages 3 and 4. Just a quick recap what the market looked like. So on the upper right-hand side, you see the quarter return. That top group, the red and the pink columns there, are returns for international equity markets, so up 3.5 or 2.3% for emerging markets. You'll see that group of dark and light blue columns beneath that. That's the S&P 500, and then mid caps and small caps at the very bottom. And the biggest change that we saw here, the biggest rotation, was large caps had outperformed before November of last year during the outset of the COVID crisis, but now you see as of early this year, small cap stocks have taken the lead. What that kind of tells me is that value stocks underperform growth stocks. Early on, the mega cap growth stocks, the Amazons, et cetera, Microsofts, the stay-at-home trade, if you will, performed the best during the most uncertain times of the pandemic. And now that it appears we have light at the end of the tunnel, the other parts of the market are performing. Now, the nice thing about that is that growth stocks, large cap stocks had a very good, very long run. And they left small caps, they left value stocks by the wayside. And so what's performing now is not necessarily expensive, which means that there is some room for those companies to continue to perform. What did not do well in the first quarter are bonds, and that's in the green section. Remember, if yields go up, if the price of money goes up, the price of bonds go down. That's what happened during the first quarter. Trailing 1-year returns just astonishing. In the table in the chart below that, you can see international equities, the poorest performer amongst equity markets that we observe, up 49, 58%, just amazingly strong results there. The S&P was up 58.4, but with a surge at the fourth quarter of last year and the first quarter of this year, you see the Russell 2000 up almost 95%. Again, unusually strong returns. That's usually about, trying to undo the compounding in my head, but that's about 8 years of normal returns for small caps, and we did that in 12 months. And then as you see bonds below, bond yields are low, they're a little higher than they used to be, but there's not a lot of room to produce returns. And I think that our decision to favor equities a little bit more than bonds last year has been helpful. So the next few slides are going to be performance of large cap growth. This is growth versus value. Blue is value, red is growth. And you can see here the big switch that's happening. So during the first quarter of this year, top chart, bottom set of columns, Russell 2000 value. Again, these are going to be energy companies, insurance companies, small banks, cyclicals, up 21% during the quarter, and small cap growth up 4.9%. So the gap was gigantic last year between value and growth stocks. And this is what happens when things get historically out of range. When the recovery happens, it's very swift and very strong. And then looking down at the 1-year performance, you can see that when you outperform by 15% in a quarter, it really brings those two sets of value versus growth into alignment very quickly. Can we go on to, I'm not going to do much on the individual, so can we go one more slide here? There we go. So this is the indexes that represent the market and the biggest stocks and how they performed during the year. So if you look on the left-hand side at the top, Russell 1000, this is what's called a cap-weighted index. So the biggest companies in the United States are represented in larger shares of this benchmark. And you look at that. So Apple, of course, biggest company, 5.15%. Microsoft right after that, 4.7%. And over the trailing 1 year, those are up 93, 94%, 51%. Amazon there, Facebook just below that, and then Google below that, called Alphabet. And then you have Tesla, everybody's favorite company to talk either extremely positive or extremely negative. There are no lukewarm opinions about Tesla. It's either the most expensive grift in the history of markets, or it is the most overshorted company because people just don't understand the opportunities out there. But over the last year, it was up 537%, just incredible. So that leads to another takeaway, which are story stocks are leading the market now, and there's no better demonstration than that, than the next set down there. I'm sorry, on this slide, the green boxes there are Russell 1000, the Russell 2000 on the right-hand side by performance. So you thought that Tesla was an astonishing return, going up 537% last year. A story that we will not forget is GameStop, up 5,000% over the trailing 12 months. I don't know that I've ever seen anything like that. I mean, that's a, I don't mean to demean this, but that's a company that comes out of nowhere and cures cancer type return for 1 year, up 5,000%. AMC and Cassava Sciences, that is one that's actually doing some good work in the healthcare industry, but AMC Entertainment, they own the movie theaters. Another one of these companies that was up huge story earlier this year, up 381% during the first quarter. So that was sort of the takeaway the first quarter. You saw the transition from growth to value, from large to small. Bonds were not great, but the story stocks are kind of leading the way and sort of casting aside, at least for a little while, the fact that markets are all completely efficient all the time and index funds are the way to go. So can we move on to a few more slides here? International equities are lagging behind the U.S. as they lag behind our recovery from the pandemic. And then as we go to one more slide here, fixed income. So these are bonds. We have bonds in the portfolio. They match sort of the the return long-term or medium-term liabilities that we are attempting to defease with this pool of assets. But you can have losses in bond portfolios. And if you look at the first quarter here on the upper right-hand side, you can see that the losses can be pretty painful in the short run. This is a bad quarter for fixed income. And with the idea that, $5 trillion in money printing effectively last year will cause an inflation. We're seeing that in all sorts of commodity prices right now, gas, natural gas, oil, lumber, etc. And when prices increase, because bonds are contractual instruments that pay income and return principal at a period of time, bond prices go down. So as a bondholder, you suffer losses. The upside to this is that you will eventually mature at par. So bond prices are pretty volatile in the short run. Over the last year, what did best? High yield bonds. Thankfully, we've got a nice selection of those in the portfolio. So as we go on here, I think I'd like to go to page 12 if you could. There we are. This is the long-term since 2008 total fund market value over time. And what the blue line tells you is where the market value is. You can see we're at an all-time high, and we grew very quickly coming out of the pandemic quarter in the first quarter of last year. Net cash flow. So if we start with the amount on the left-hand side of $126 million, net cash flow. So think of this as how much we have paid out, $77.8 million, and that gives you the net cash number on the right-hand side. We've had gains of $285 million, giving an ending market value of 333. So before too terribly long, well, it'll be several years, but if we keep up even modest returns, the net cash flow will be more than the beginning market value, meaning that the compounded, the effect of returns and compounding on that initial value will make the beginning market value effectively smaller than the amount paid out. Okay, could we go 2 more slides to page 14? So our allocation, you notice that domestic equities are higher quarter-over-quarter. You can see that 41% in domestic equities, that's 2 portfolios. Fixed income are the next 2 at 12 and 11.8%, and international equity at 10.2. If you recall, what Rachel has said is she's pulling all of the funds that we have or that we need for benefit payments are coming from fixed income. As we target a 630 being at our target asset allocation, the new one, we may have to actually pull more from there to reallocate, but as of the 630 market values, we're going to make a final assessment. Again, long-term oriented, long-term equity oriented. The bonds are there to pay near-term benefits. Equities are there to build long-term asset returns. Looking down the list there, high yield fixed income, active duration fixed income, real estate at $14.4 million. Please remember, we funded this at the beginning of last year-ish at $14 million. So despite all the claims that real estate is a bad place to invest, we've actually made some money over a relatively short period of time. In the MLP portfolio, energy infrastructure, $11 million to start the quarter, $13.5 million to end the quarter. So returns have been strong, and it's about time, honestly. We were very patient with that, and it's good to see. Oil at $65 a barrel, which is about $105 higher than it was April of last year. Don't understand that still completely, but here we are. We went from oil having a negative price to having not enough oil on the East Coast or gasoline in the course of about a year. That's how quickly these things can change. So I'm going to go through returns very briefly here, and that's going to be starting on page 18. Perfect. Quarter returns, 4.07 for the total fund gross of fees, 4.05 net below that. You can see 1-year return of 35.6. Policy index was 32, so we outperformed that by a wide margin. And you can say in rough terms, we did 5 years worth of actuarial returns over the last year. That's good. Let's not count on that. that is possibly a once in a lifetime type result. If you look at the last 3 years, 8.5%, last 5 years compounding at 8.67, and over the last 10 years, shockingly, 7.25 over the last 10 years compounded, which is exactly the same as the actuarial assumption. So hopefully that will help in our discussions with the actuary. Looking down that list for the trailing 1 year rate of return, I don't want to just focus on that because the numbers are so big, but I think we should. Looking at the State Street, the S&P 500, 56%. For the Barrel Hanley small cap portfolio, 118.92%. Again, this is a portfolio that's concentrated. It has brief periods of extraordinary returns. Sometimes it lays fallow for a while. Last year was one of those. Over the last 10 years, it's compounded at 12.59% per year, which is in long-term returns, that is a massive contributor to results, and that is a relatively large portion of the portfolio. I know if you're new to this board, that looks big at 25%, but it is the portfolio that has driven a lot of the long-term results here. Tocqueville is the international equity. Its returns were at 54% last year. Its benchmark was 44. And then the MLP portfolio, 95%, and the index of 103. So we had two portfolios that were amazingly close, if not over 100% return over the last year. Next slide, please. Our fixed income portfolio, looking over the last 1 year, we've got a negative return there. That's the long duration bond portfolio. 30-year treasuries are in a bear market. They recovered during the month of April. But again, if any portfolio is going to be down, this is the one I want to see down because it hedges, it moves the opposite direction of the equity portfolio. And if we're going to be adding funds to a bond portfolio, this is one it's a good time to add to it. If you look at the cyclicality of this portfolio, it's not exactly predictable, but it does follow a pattern. When it's up big, you want to take money away from it. When it's down big, we want to put money into it. You'll see our one thing that I will be working on this year, if we have a topic for the year, it's going to be fixed income and how we need to be thinking about that going forward, because we're not going to have the long-term returns that we've had for bonds. Interest rates are too low, so we need to be thinking about ways to diversify that and potentially shield the portfolio from rising interest rates, potentially streamlining as well. Completely different story is the high-yield bond portfolio. Again, these used to be called junk bonds. During periods of rising equity markets, they do well. You can see that this portion of the portfolio is up almost 28%. Over the trailing year, we have two portfolios, Aberdeen and Lewis Sales. Their returns were absolutely phenomenal over the last year. And then our real estate, both of those have been marked up somewhat. So they started with $7 million each, and that's where we are. And then the liquidity pool, which is judgments plus a little bit of cash at $4.95 million. I'm going to do a big jump here unless anybody wants anything about individual portfolios. We don't have any major organizational developments at any one. We're still watching Siegel Bryant because they've had a combination. They were bought out. So watching it very carefully. But as far as anything detectable at any of these firms, if we could jump all the way to page 46. So this is the quarterly returns going all the way back to 1997. So these are actual returns that you can observed here. And they're color-coded. So black's positive, red, dark red is negative. And looking at the far right-hand side, at the very bottom there, you can see our 4 quarters. 12.37 for the second quarter of last year, 3.35, 12.21, and then 4.07 for the first quarter of this year. That's a remarkable run. It's an amazing run. The only one that's anywhere close to that is going to be 2009, starting with June, September, December, and March. And if you notice here, we tend to have groupings of large returns, either positive or negative, kind of in very close succession to each other. So you'll notice in that 2008, 2009, we got September of 08, That was Lehman Brothers. That was when you had to watch the news starting on Sunday morning because that was when bad news was coming about commercial real estate, Fannie Mae, Freddie Mac, AIG, just Lehman Brothers, like I said. But you'll see 2 quarters, -6 and -13. The only quarter worse than that was the one we had first quarter of last year, down 13.84. And then when I look at the positive returns there, the 12.37 and the 12.21 on the lower right-hand side, the recovery, the only one stronger than that was September of 09, 13.75. So let's keep this in mind that when markets go down, traditionally in the modern era, I would say, they tend to come back very quickly. So that's why we don't sell equities when they go down. This is a very long-term portfolio. And if you can't stay positive, can even contribute some to equities, you can take advantage of that. This last time, there was simply no time. It turned so quickly. The bear market that we had here in February, March of last year was about 5 weeks. The market went down faster than it had ever gone down than perhaps 1987 or some of the Great Depression, Great Market Crash of 29. So that's our history lesson for today. And if we can move to page 50, this is our new asset allocation. Each of these individual columns are the categories that we have fixed target asset allocations to. The gray bars represent where we can be allocated and still be within investment policy. The black line is the target for each of those categories, and the green arrow is where we were as of March 31st. So the top column is our small mid-cap equity. With the return that it had, it got up to target faster than I've ever seen a portfolio do that. So we are at target there. The core equity, that's our index fund, slightly below target. MLP still slightly below target. I think we all made a promise to each other that we're not going to allocate to this portfolio, given how volatile it was. I think the promise maybe is too strong. We had an agreement that we were going to maintain this portfolio but not allocate additional assets. I mean, looking back in hindsight, it would have been great to, but I still think that the oil and the energy markets in the United States were just too difficult. And it's somewhat ironic, the fact that over the last year, it's when we've seen performance come in for this. International equity, we're still below target there, right? Our allocation is 10%, our target is more than that. Where are we overweight? Intermediate fixed income or fixed income. So as we move to mid-year, as we move to our target date to have our new target asset allocation implemented, there is some likelihood, unless equities continue to be as strong as they are, that we will be taking away money from fixed income and giving to equities. And I'm okay with it. I didn't want to rush this, given the uncertainty that we had over the last year, but we were able to maintain our equity allocation, and we'll be taking away from, and again, unless fixed income, unless we see rising interest rates affect the fixed income market or the equities continue to drive much, much higher, probably going to have to do something as of the end of June. It's not a big deal, but again, the moves that we've been making, that Rachel has been making during the first quarter, we took $2.2 million from fixed income and moved that into pay benefits. So we haven't done the trade where we take from fixed income and give to equities. We've only been taking from fixed income to pay benefits. That might be the change as of the year. So unless there are any individual questions about the 331 report, it's a great quarter. Again, fantastic. Excellent. Very, very efficient today. As we go, can you go to the next slide here? Just the market environment. It's been a positive year for equities, a negative year for bonds. And you see the first quarter, the right-hand side, you see the table that has the red, the green. Bonds are the negatives, and so the lowest performer in each month and the year to date is shown in red, and bonds are the poorest. Global bonds are the worst. Thankfully, we don't invest in global bonds specifically, so we didn't have that. Russell 2000 had 2 months in the lead, and then the Russell 1000, which are large cap stocks, now in the lead. Year to date through April, Russell 2000 is still leading 15% versus 11.6. So that's 4 months, and that's better than what we project for an annual return from those asset categories. Looking at the returns of the equity sectors here, again, only one on a month-to-date period was negative, and then on the year-to-date period, energy is by far the leader on all of those categories. So again, last year's worst is this year's best, and we're seeing Apple and Amazon, those companies sort of take a backseat to more obscure companies, I guess you would say. We did have a positive return on fixed income during the month, which was good in absolute returns. And then on the next slide, this is where the money came from in the month of April, 1.1 million from Stephen Bryant and Carol Hanley. Next slide. This is a year to date. You can see the total takeaway from those portfolios is $4.2 million. And where that's gone is gone into the liquidity pool. You can see contributions of $5 million, but distributions have been paid. So again, our job here is to produce pension benefits, and that's what those distributions are. Next slide is, actually, can we go back one? Rachel and I, if you'll pay very close attention, the figures that we quote are a little bit different almost every month. She said the ending market value was 340. Is that right? So we're off a little bit here, but the appreciation for the year-to-date period is almost $18 million, and that's all from equities. Equities produced 22.2. Fixed income was actually down almost $5 million. That's realized and unrealized returns. So that's gives you an idea of what the returns look like in dollar terms. Thank you. Next slide. For the month, we're positive. The driver of long-term returns is going to be that Merrill Hanley portfolio. It was up 0.85. Its benchmark was up more than that. Looking back over the fiscal year to date, it's still up significantly more than its benchmark for 1 year. And for the trailing year, remember, we were at 35.6, March 31. But as we go into the trailing year, as of April, we dropped off that first recovery month. So we went from 35.6, trailing 1 year return to 29.3. Again, not a terrible result all in all. You look at the trailing 1 year returns for all of the portfolios, again, led by equities, fixed income are modest or even negative. And then the final slide is next. Thank you.
Waiting.
You can see there that our high yield portfolio is doing well, outperforming, and you can see that our real estate portfolios for that the initial year-to-date period, 2.13% and 3.66. So definitely not the worst case scenario we were dreading last year for real estate. And that concludes my comments for periods in 331 and 430. Happy to take any questions.
Move to approve.
Thank
They're on it. Baker,
Yes.
Fothergill,
Yes.
Little, yes, Lee,
Yes.
Willis,
Yes.
Hurd, yes, Piper. Yes. Are there any additional items not known before the posting of the agenda? Committee reports? There are none. The chairman's report, I would like to congratulate Sunderland, who will be taking over in July. So congratulations. She'll be taking over from me.
Oh,
Y'all get rid of me and you can have Sunday. So congratulations again for that. Discussion and action, refunds to be paid by June the 7th. I would like to take those 1 through 9, please.
Move to approve. Second.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord, yes, Lee,
Yes.
Willis,
Yes.
Hurd,
Yes.
Kaiser. Yes. Payment of the following invoices, 1 through 9, please.
Approve. Second.
Baker,
Yes.
Fothergill,
Yes.
Little, yes, Lord, yes, Lee,
Yes.
Willis,
Yes.
Hurd, yes, Kaiser. Yes. Approval of military service time for German Warzow.
Move to approve.
Second.
Baker.
Yes.
Fothergill.
Yes.
Little.
Yes.
Lord.
Yes.
Saleed.
Yes.
Willis.
Yes.
Hurd.
Yes.
Kaiser.
Yes. And approval of retirement pay applications effective June the 1st of 2021, 1 through 7, please.
Move to approve.
Second. Baker.
Yes.
Fothergill.
Yes.
Little.
Yes.
Lord.
Yes.
Saleed.
Yes.
Willis.
Yes.
Hurd.
Yes.
Kaiser.
Yes. Approval of surviving spouse benefit for Ronald W. Vaughn, surviving spouse of Juliet.
Second.
Baker.
Yes.
Fothergill.
Yes.
Little.
Yes.
Lord.
Yes.
Saleed.
Yes.
Willis.
Yes.
Hurd. Kaiser.
Yes. Approval of cancellations of benefits for the following 1 through 5, please.
Move to. Second. Baker.
Yes.
Fothergill.
Yes.
Little.
Yes.
Lord.
Yes.
Saleed.
Yes.
Willis.
Yes.
Hurd.
Yes.
Kaiser.
Yes. Revocation of approval of suspension of benefits effective April 30th for Randy Sunderland.
Move to approve.
Second. Baker.
Yes.
Fothergill.
Yes.
Little.
Yes.
Lord. Yes. Saleed.
Yes.
Willis.
Yeah.
Hurd.
Yes.
Kaiser.
Yes. Any new business?
I just want to, I know, I think all of you have gotten the email about the trustee education conference. So, I think they're only going to allow 2 people from the board to attend right now.
That's not the way I read it. It was 2 staff.
Okay.
It was, the way I read it, it said all the board could attend, but only 2 staff.
Strike my comment.
Okay. Any other new business or?
Move to adjourn.
All those in favor?
Aye.
Thank you.
Thanks, everyone.